The last 2 weeks, we've had a 2 million barrel per day inventory draw, crude inventory draw. The last 2.5 months, it's been a 1 million barrel per day draw. So counter to what the oil price looks like, the global crude inventories are drawing. Since July 6th, we've drawn 200 million barrels. So that's onshore, plus about another 50 million barrels of on the water crude. Maybe 75 plus million barrels. When you add in the oil on water plus the floating storage, I would say something like 75 to 80 million barrels of draw, crude draw. So behind the scenes, the physical market still looks great. And well, what about spare capacity? We have all the spare capacity, meaning that oil price should never go up. Well, the spare capacity is going to be put out only if they want it put out. It's not going to just be rammed into the market if the market is not looking for it. It could be a very slow release of spare capacity. Let's not forget that during the 2010 to 2014 bull run, we had 2 to 3 million barrels per day of spare capacity. The world has never been in an era of zero spare capacity. To go and make that point, I think is just fundamentally false.
Hey guys, Capital Cosm here. Before we start this video, I just want to let you know that I believe that we are on the cusp of a major uranium bull market. Now, these things don't happen every other week. The last uranium bull market peaked in 2007, the one before that in 1978. So when these things happen, you've got to take advantage of it. And how explosive are they? Well, you've all heard the stories. Uranium skyrocketing from $10 to $20, all the way up to $150 in these uranium bull markets. Where will it go this time around? Well, we don't know. We'll see. But you've got to take advantage of the opportunity. What better way to do that than to leverage Justin Hune's Uranium Insider newsletter? You get access to his monthly newsletters, his webinars, his stock picks, his portfolio, all of that stuff. You get access to guests that you may not see on YouTube. You get access to having them ask questions that you may not see anywhere else. So I highly recommend, if you're going to take part in this uranium bull market, you check out Uranium Insider. Link is down in the description box below. Be sure to click the link. There's quarterly plans, there's annual plans. So if you're kind of tepid, you're kind of hesitant, you could always go with the quarterly plan. Kind of test things out, sample things out, see if you like it or not. But the way I see it, guys, you've got to pick the right stocks. A lot of these uranium companies are not going to make it to the other side. Now, and Justin Hune's uranium portfolio has outperformed the likes of URA by a significant margin. Since 2019, it's up 5x from where it started. So click the link down below and we'll get started right now on the video. Thanks, guys. Hey, guys, welcome to Capital Cosm. Today, I have a very special returning guest, an expert in the oil fields and the oil market. It is Mr. Shubham Garg. Shubham, thanks for coming back on the show.
Yeah, it's good to be back. Being kind of away for a few months off Twitter and Zoom and everything. So we'll get back into it. A little bit rusty, but hey, we'll talk oil and gas, which is what we love to do.
Yeah, let's do it. As always, nothing in this video is financial advice. Neither Shubham nor I are financial advisors, so please do your own due diligence with that, Shubham. For those who may not know who you are, I know we had a podcast or show prior, but for those watching us for the first time or watching you for the first time, briefly give us a description on who you are and your general prognosis of the oil market.
Yeah, you bet. So Shubham Garg, petroleum engineer by background, worked in the fields, operating wells and doing production optimization, well site supervision, really trying to learn right from a wellhead level what's going on in the oil and gas industry. So did that for about 4 years. 2021 moved more so full-time into investing, which I've been doing since 2013 anyways, but more full-time, started creating some content on valuation and geology and engineering, how to look at cash flow, sensitivities and company well-by-well results, etc., and kind of use those both to become more of a sort of private equity type scenario where we've got 5 or 6 companies now where we own between 8 to 30% between White Tundra and a sphere of influence, and really help the companies with getting capital, getting debt financings, help them on the engineering front without having any G&A cost added, look at potentially acquisitions and funding them. So just a whole scale, assisting them not just as investors, but also business development, investor relations, et cetera, getting the word out in a technical manner as well. And yeah, about 6 months ago, well, it's been almost a year now, launched White Thunder Petroleum, which is a foray into owning and operating our own assets. So kind of multiple different branches to take advantage of what we feel is a extraordinary opportunity in the oil and gas sector, where when the opportunity seems the most obvious, in the sense that the macro is the strongest for this cycle, it seems like the least people are willing to put their money into it, creating an even larger skewed risk reward situation, as long as you have the patience and as long as you have the understanding of the sector. So, of course, a very, very volatile sector, a very opaque sector with a lot of information that is not publicly available. But when you got companies trading at 2 times cash flow on a commodity that we all consume every single day, and nobody's willing to put their money into it, well, we'll take that opportunity and kind of run them through the cycle at a time where the oil macro is just gets more and more exciting every time we talk. There's many factors here. But at the end of the day, you want to look at your bullish factors and your bearish factors and how long they can continue on that way for. And we're setting up for an even better and better cycle. I think one of the things that gets misconstrued here is that, hey, oil prices, $77 today, so you were wrong in the sense that it's not 100 plus. Well, the longer that oil price stays below that critical mark, where you see this flood of investment come in, the larger and larger that divergence between future supply and future demand goes, creating a even longer cycle and creating a cycle where prices stay higher for longer, in order to spur that investment into the sector. So really investing in a strategy that works for that specific setup, and then as the markets change, adjusting that strategy as required going forward.
Yeah, so we've seen conflicts in the Middle East transpire over the course of the last 3 months. The Red Sea, the issues going on there, but yet WTI still sitting around $77 at the time of this recording. We did spike up momentarily. I think you mentioned, what was it, $94 at the start of the Middle East crisis. But what's been going on? If this doesn't spark an oil rally, what will?
Yeah, great question. I think one that's on top of everyone's mind. So, historically, when you look at it, when oil prices are higher, there has been more violence. There's more at stake. There's more power struggles. There's more money that people are looking to control and reallocate for their own specific mandates, whether it's takeovers or wars or internal construction and development of a country. So more violence is generally the way things go. In this specific scenario, we're seeing Middle Eastern violence at a time when interest rates are a lot higher than they historically have been in times of conflict. So before the Hamas and Israel issue happened, we saw record low percentile on our net longs on the paper markets. So about a 2 percentile on historic net long for WTI plus Brent contracts. And as soon as the conflict happened, we saw that number rise up. It went to about a 40 to 50 percentile. And what did we see? We see oil price rise $20 a barrel in pretty much no time, and a very, very strong momentum move upward. And as soon as the US sent their 2 aircraft carriers in there, the balloon got deflated. And where do we sit today? At that 2 percentile. So it creates a sort of confusion in the market, because people are wondering, well, why are these paper markets not willing to go and bet on more conflict? And I think really the answer lies in interest rates. People are unwilling to go and pay the margin requirements and the dollars required on the interest to go and make a bet that there's going to be more conflict. And again, these are the same people that got caught in a very weird situation in 2022. They bet on the Russia-Ukraine situation. They bet on 3 million barrels, 2 million barrels, 5 million barrels in some cases that was potentially going to go off the market, depending on which source you looked at, from a Russian export standpoint. And that never happened. So they had these huge contracts and completely out of the money once that market softened up in late 2022. So definitely a bit gun shy as well moving forward. So you add up all those factors, and we sit at that 2 percentile. And what does it mean? Well, it means that there's a sort of a floor in the market, in the sense that, yeah, you can still go and keep selling contracts or keep liquidating your longs, but to what point? Do you really want a market that's completely net short on oil? Why would somebody go and make that bet when they don't need to? So I think we're at a pretty good point where you have this floor, because we're so low on the paper market percentile, and then you also have this huge swing upwards that in the case of some sort of real conflict, not saying that conflict so far is not real, but in terms of a oil tanker completely getting blown up and sank, or some sort of U.S. embassy attack where multiple servicemen die, or whatever, should a actual attack like that happen, you're going to see this surge in the paper markets. And again, we don't want to be betting on any sort of mass conflict or mass violence, but that's just the reality of the oil market. And where we sit today is that when that does happen, and you sit at such a low percentile on the net long, the upward move is going to be exceptionally violent. And guess what? When these companies trade at the kinds of cash flows they do, and they have these sensitivities to higher oil prices that they do, well, that $20 move in oil price could, for some of these small cap and junior companies, 3x their free cash flow number, because they're just higher break-even producers. They have a little bit of debt on their balance sheet, and I think that's what we're betting on in some sense. But at the same time, we're betting on the overall macro thesis of an undersupply structural bull cycle, which we saw bits and pieces of it throughout 2021, 2022. And I think we're going to continue to see that narrative get stronger, and the physical barrel just gets stronger as time goes on, especially with the low inventories that we're currently sitting on. We don't have that SPR buffer anymore. We don't have this excess floating storage buffer anymore. We don't have this excess crude in the U.S. Commercial inventory anymore. We don't see China having a excess anymore. They've dropped about 80 million barrels since their peak inventory there. Sometime mid last year, I'll say. So you don't have the safety net anymore, and that's where we sit. So we sit at a point that's very confusing to people, because we should be at a midpoint, but we're not. We're sitting with everything going against the bulls, but that one spark is all it's going to take. That we have multiple factors that can really accelerate that move upward.
Yeah, it really begs the question, what would the oil price be now had it not been for all those different factors that you just alluded to now? If there's no way to really know, we would need like a control Earth versus our, this Earth, to kind of see like what was the actual effect of all this conflict in the world to the oil price. For all we know, the oil price could have dwindled down even further. But you mentioned the interest rate. Fed funds rate sitting at about 550 basis points. There has been talk of pausing and even cutting rates in 2024. Now, with cuts on the table, what exactly does that mean for the oil price?
Yeah, 100%. So to the first part of your question, I think one that I get often enough, the question you got to ask yourself is, if the conflicts didn't happen, where would we be, right? That's the main question. So on the paper side, nobody cared anyway. Nobody cares at this point, given where we are on that net long. Nobody's betting on this continuing. People are betting as if the world is still in a safe environment. So not too much you can say that, hey, if the conflicts didn't happen, we would potentially slide further, because we're already at such a low net long percentile anyway. On the physical market, one could argue that the conflicts that we have so far have had zero impact on the physical market. We don't see any issues with Russia crude exports thus far. There is issues behind the scenes in terms of the sanctions affecting some of the newer projects, affecting some of the supply that could come online as the decade goes on. But at this point, there really has not been any major physical market issue. There also has not been any major physical market issue with the Middle East conflict. So given that the physical barrel has not been affected in the relative scheme of things, the price really should not be much different than where it is today, given the supply-demand imbalance or balance that we have right now. So I think really important to think about that. We can't just say that, oh, if the conflict didn't happen, we might have been in the 60s or 50s. And that again begs the question, okay, well, if we were there, would OPEC just cut more barrels and we would still be here, but with just a higher supply excess that could have been brought on the market as the cycle continues. So spare capacity, we'll say. So really taking that into account. And then to this, remind me again the second part of the question.
Yeah, so interest rate cuts effects on the oil market for 2024.
Right. Yeah, so I think many effects on, again, both the paper side and the physical side. So on the paper market side, people are unwilling to pay 5.5-6% interest plus the margin interest that they have to pay on that. You're not going to pay Fed funds rate on borrowing money from Wells Fargo or from Merrill Lynch. So as that rate comes down, there's going to be more activity in terms of who is willing to make a bet on the paper side on increased violence or undersupply going into the future. People are also going to start pulling money out of long-term instruments or short-term instruments. If I'm sitting here and I'm getting a T-bill at 5.5%, sounds good to me. I'm going to put my money in there and I'm happy. Real estate investors, they'll invest at a 5, 6, 7% cap rate. So if they can get that same 5.5%, 6% tax-free, why would they not do that? But as that rate comes down, it doesn't have to come to zero. It comes down to 3.5%, 3% possibly. Now the investor is thinking, okay, this is not enough of a return on a risk-free, in quotation marks, on a risk-free basis that I'm happy with this return. They may be happy with 5.5, but not with 3 or 3.5 or 4. So they're going to want to put that money to work. And where is it going to go? It's going to go into the debt markets. It's going to go into private equity. It's going to go into the stock markets, and more money is going to be put to work, not just on the physical contracts of oil, but just in general into the economy and spurring some of these developments. You've seen some of the data on which construction projects are getting slowed down or delayed because the construction loan is too high, or because they don't think there's going to be enough of a demand for that apartment or that commercial complex at that point in time. So that once that money is put in the market, what does it do? It adds physical demand. So if you now have 20 more apartment complexes and a mall and XYZ thing being built because that dollar is going into the real economy, well, that's going to add to your diesel demand. It's going to add to your mining of metals. It's going to add to your concrete creation and steel. And that's your physical barrel impact then at that point. And very, very hard to quantify. I think this is one of the big problems is how are you going to quantify what difference does it make? But really, you have both a money impact into the economy that then creates the physical impact on the economy. And I think you're seeing some of it already with people getting more and more used to higher interest rates and still willing to take on some projects. I can only really speak anecdotally to this. Don't really have hard data, but definitely more construction projects still going through than what we would have thought in this sort of interest rate environment. So as that comes down, there's people ready to hit that button because they already have the permits, they're already approved, they already have the contracts for the materials, they already have the contracts for the labor. All they need is to hit that button, and well, bam, your physical barrel is now going to be consumed. And that's not just in the US. This is a worldwide phenomena where some of the growth rates in GDP and petroleum consumption in the emerging markets is being throttled because of the high interest rates. And hey, if that country doesn't have high interest rates, their currency is going to keep devaluing against the US dollar. So they're just going to keep paying higher and higher prices, and they don't want that. So as that US interest rate comes down, the emerging markets can now go and accelerate their own developments. And that just creates this snowball effect in a world that right now, I think that's the best way to put it. The world right now is throttled. You have a vehicle that can go 200 miles an hour, but they're governing it at 125 miles an hour. So even though you want to push, you're just against this limit. And as you remove that limit, the economy wants to go faster and faster. It just is unable to in today's interest rate environment.
Yeah. So in 2023, we had the highest oil production, I believe, of all time.
Yes.
What exactly does that mean in light of, what is it, 15-year highs in interest rates? How did we pull that off?
Yeah, so one that's I think very very interesting, and it requires a engineering explanation as well as a sort of physical explanation. So the what happens when you have lower oil price for 7 years is I've got 20 wells, I've got some wells that are really good, I've got some wells that are decent, and I've got some wells that are marginal producers. So over those 7 years, things break. I'm talking between late 2014 to 2021. Things break. You got wells that break, you got wells that go down. Let's say there's a big winter storm, your entire pipeline is seized up with oil and hydrates. You don't want to do anything with it because oil is $50 a barrel. From 2015 to 2020, a 6-year period, WTI averaged $50 a barrel. So you don't want to bring those wells back online. Well, now 2022 hits and you get 95, 100, $110 a barrel. Now you go and you tell your operator, hey, that well there that used to make 5 barrels a day, get the road cleaned up because we're going to go put a rig in there. We're going to bring this well back online after this many years off. And what happens when you bring a well on that's been off for 7 years? It doesn't make 5 barrels a day. It's going to make 20, 30, 40 barrels a day for a period of time. And then it's going to, that flex production is going to taper out over time. So a lot of these wells across the US, across Iran, across Iraq, Canada, Brazil, name any country, these wells started to come online. You see this when you look at some of the graphs of the production, the oil production. You'll see the country's production going like this, and then it flatlined in 2022. And then there might be a slight curve up in 2023 or just flat lines from there onwards. So you saw a lot of these wells come back online, add supply to the market in 2022. You also saw the American production be very, very resilient. I myself am shocked, surprised at what's happened in 2022. 2023, even more so, because really we had a big surge in 2022 already. And then 2023, we saw degrading well productivity. We saw the rig count drop. We saw the frac count drop, and they still were able to add a significant amount of barrels in 2023. So that looks to now be flatlining. We thought this would happen 6 months ago or 12 months ago. It didn't happen. We saw a lot of private producers still continue to add barrels. And of course, we saw the resurgence out of Iran, the increased production out of Iran. We saw Canada add 200,000 to 300,000 barrels a year. And then Brazil. Brazil has been one that has kind of got ignored because they never met their production targets. So when they were drilling in these post-salt basins, they always had problems with getting production online. Now that they're in the pre-salt, they're actually doing way, way, way better at getting these barrels and hitting their targets because the wells are so prolific. So really, it's become a country to watch. Petrobras is one that puts out very, very transparent information on when their FPSOs are coming online. So relatively easy to track, which we like. And you add all these factors together, and we saw in 2023 still have, I'm not going to say the highest oil production, the highest liquids production ever in 2023. So when you add the NGLs and some of the butanes and propanes that are being produced out of the US shale, it had the highest liquids production. And really the question going forward is, can you just run that same supply graph line on the scale that it's been going on, or the trend that it's been going on? And I think that's really where people are going to get caught off guard. And again, we thought this would happen 6 months ago. We thought this would happen 12 months ago. The worldwide supply has been way more resilient than we had figured, especially when you add in the NGLs and the butanes and the propanes. Going forward, people continue to graph that same trend line when there's a lot of one-time effects here. You had a lot of wells that were DUCs. We're now back to, in the US, the drilled uncompleted count is back to 2014, 2015 levels. So we've burned off all this excess insurance and gravy and extras that we had in the market. And those are one-time effects. The one-time effect, though, has lasted for 24 months. And that's where I think people are getting frustrated. They're getting a bit jaded with what's going on. And it's gonna swing back the other way. It's not gonna suddenly start declining, but it's gonna not grow at the same pace that it has been. And then we'll see what the real oil price should be, because the one thing that's been stable for the last 100 years to 200 years has been the oil demand growth number at that roughly 1%, 1.5% clip. That's been a straight trend line. Supply has gone up, has had its ups and downs, and really, I think the main factor to watch on supply. You've got Iran, you've got Brazil, you've got Canada. We know they're going to add barrels unless there's some sort of geopolitical conflict. We know they're going to add barrels. But what happens with the US? The US is the reason for what's happened to oil prices from 2014 onwards. And if the US shale starts to show signs of further degradation and continued issues with increasing production, that's, I think, when you see some real interesting things happen. You see the physical market get tighter, but also the paper markets are more now willing to go into it because they don't believe that shale can just add that million barrels every year. So that's going to take time. It's not going to happen at the first sign of exhaustion. It's going to happen 6, 12, 18 months slowly over time. And again, this is something that I get a lot of pushback on is, well, you were wrong on the shale thesis in 2023. Okay, we were wrong on the shale thesis in 2023, but the thesis has not changed. You are going to reach a point where that exhaustion, you're not going to add that million barrels per day. And all you got to do is graph New Mexico production from 2020 to 2023, and you'll see what I'm talking about. It's going up, 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 and then it goes flat lines. And you plot Texas production. Well, it's going up, 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 and then it flat lines. A lot of the growth has come from North Dakota. It has come from the Gulf of Mexico with projects that were sanctioned years and years ago. So yeah, I think it's a let me see if I can pull it up and actually share it. But it's a very interesting time in U.S. oil production, because you plot the entire graph, and here, I think I can share my screen. Yeah.
Yeah.
Yeah. So you see the entire U.S. production continues to go up, but other than the last couple of months. But then if we take the U.S. out and we look at New Mexico specifically, you can see how that's 2020. You got the straight line going up, and then this is April 2023. We still have not hit that April 2023 number, and we've got about 6 months of data after that, and we are not just flat, we're actually on a downward phase with no weather events, no problems with any sort of issues going on in terms of infrastructure. And then you plot Texas, and you see that same flatlining effect. So here's 2020. You got this trend line going up, and you can see how it's flattening out here over the last 4 months. So people just keep repeating the same number on overall U.S. production. Well, it's the two states that were growing that have stopped growing. That's really the key point here. And we'll just let it play out. There's no rush in oil cycles. These cycles take long. And guess what? People make multi-generational wealth every cycle, as long as you have the patience and you compound your wealth accordingly.
Yeah. So I hate doing this to you, man, but if you were to make a prediction for 2024, it's an election year, number one. There are people out there saying that we could enter a recession. Two, that's another headwind for oil. The election being another headwind for oil, FYI. Where do you see oil going this year?
Yeah, so the trillion-dollar question, multi-trillion-dollar question. So think really you have multiple things going on here. So I'll just throw some data out here. The last 2 weeks, we've had a 2 million barrel per day inventory draw, crude inventory draw. The last 2.5 months, it's been a 1 million barrel per day draw. So counter to what the oil price looks like, the global crude inventories are drawing. Since July 6th, we've drawn 200 million barrels. So that's onshore, plus about another 50 million barrels of on the water crude. Maybe 75 plus million barrels. When you add in the oil on water plus the floating storage, I would say something like 75 to 80 million barrels of crude draw. So behind the scenes, the physical market still looks great. And well, what about spare capacity? We have all this spare capacity, meaning that oil price should never go up. Well, the spare capacity is going to be put out only if they want it put out. It's not going to just be rammed into the market if the market is not looking for it. It could be a very slow release of spare capacity. Let's not forget that during the 2010 to 2014 bull run, we had 2 to 3 million barrels per day of spare capacity. The world has never been in an era of zero spare capacity. To go and make that point, I think is just fundamentally false. We've always had spare capacity in the market. Saudi Arabia has always had a surge capacity where in 3 months they can pump an extra million barrels a day. Sure, we've always had that. It doesn't mean that they're going to do it and damage their reservoirs and add supply in the market for no reason. So that's the one point there. As far as where things overall are going to go, 2024 is going to be a flattish to up year. You're going to see tensions possibly continue to rise. You're going to see inventories continue to draw until they reach a point of no return, we'll say. But Saudi and OPEC Plus is going to add barrels to the market. If they see a ultra tight market, they will add those extra barrels back into the market, leading to this fluctuation in oil price between 75 and 105, 110, whatever number you want to pick, depending on how early you think OPEC Plus reacts. They've been late before. They've been late in cutting barrels in 2023. They were, you can say, late in adding barrels in early 2022. They could completely miss this boat again. All it takes is 2 or 3 months delayed because you add the barrels. Well, now your oil and water number has to go up. Then it takes about 6 weeks for that barrel to end up at the refiner, them to refine it, then it end up in the consumer stream. So there's always a delay here, and we're going to be stuck in this range. And what's going to get us out of this range is the paper markets. If you see geopolitical tension, if you see them believe that the shale barrel can no longer add to the growth, and people start to pile in, you could see this market overheat in no time and stay there. Especially if there's some significant geopolitical conflict. But as far as 2024, this is not investment advice. This is just the way that White Tundra allocates our capital. We feel like the best way to allocate capital in this sort of environment that 2024 is to invest in companies that are growing. You invest in smaller companies, junior companies, not exploration plays. I'm not talking about wildcatting wells. I'm talking about companies that are growing production in known fields, in known geology, using horizontal drilling, using enhanced oil recovery, doing new drilling. And while this cycle fluctuates between this very wide range that I've given you, those companies are growing their bottom line. They're growing their revenue. They're growing their production. They're growing their cash flow. So that once we get into late 2024, early 2025, now that actual supply deficit occurs with less spare capacity, so more OPEC barrels on the market, you're actually in a true undersupply. Well, now the companies in the meantime have 4x production. They've 10x cash flow. They have 20x their free cash flow in the meantime. So you end up going into the cycle with this accelerating vehicle rather than a vehicle that's at a dead stop or just barely paying off debt or giving you a 7% dividend. I'm not in this market for 7% dividend. I'm in this to make multi 100% gains. And I think the allocation for that depends on your view on oil price. If you think we're going to jack up right now, well, then small to mid caps, maybe even the large caps might make more sense. If you think that we're in a slow grind up, the cycle is going to get stronger. Why is it going to get stronger? Because the longer we stay sub 80, 90, $100 a barrel, the less investment there's going to be. That's it. That's the golden baseline of any commodity. So the longer we stay there with less and less investment, the stronger the cycle is going to be and the longer it's going to last. And you want to be in a longer, stronger cycle with a company that's growing production, can grow production, and also is growing production and cash flow in a meaningful way. There's companies that are growing 5-7%. that may be enough for what you're looking for. But in the case of what I see as where this oil cycle goes, I think this is going to be a longer cycle than a lot of people are willing to admit. And I can say this as somebody who lived through 2014 to 2020. That was a absolutely brutal time where every year it was just oh my God, like we're gonna make all this money, this and that, and nothing really happened. It just took longer and longer and longer and longer. And so for me, as I'm now 10 plus years into investing in oil and gas, um, a 2 year investment period does not seem like a huge period to me. So to somebody that's new to oil, you've been in it for 6 months or a year or 2 years. Another 2 years might seem like a lifetime. But the reality is oil cycles just move a lot slower. And I'll be the first to admit that 2022, 2023, we thought we were going to be in a 100+ cycle for many, many, many years. And that did not happen. That doesn't mean I'm not a bull from here onwards. It just means it's a more calculated bullish statement. And what I mean by that is I'm not going to rely on just oil price. The oil prices are going to be strong. They're going to go higher as time goes on. But in the meantime, I need to bet on companies that are going to benefit the most in that meantime and once we get to that higher period. And I think that's the best way in order to actually live your life while investing in oil and gas, because you can get caught up in this industry day to day to day to day, trying to analyze everything. And I know because I did it 2014 to 2020. I was on that tape every day, watching every EIA report, not as much as I used to now, but still reading the reports, still tracking companies to some extent or the other, still watching the stock prices day to day, and it wears you down. You end up losing years of your life for very little return. So I think to anybody that's been following me for the last 2, 3 years, I think that's the one biggest takeaway here is this cycle is going to be longer than we had initially thought last 3 months or 6 months ago or 12 months ago. The whole narrative that we're going to make X amount of percentage and then just exit the industry, I don't think exists anymore for both reasons. A, because the macro has pushed things further. There's been more supply on the market than we expected, but also there's more people beat down. In order to get the valuations that we're looking for, you need capital inflows. And hedge funds and private equity and family offices are just beat down with the destruction they've taken in some of these equities over the last couple of years. So we're going to need the cycle to be strong enough for them to come back. Not just strong enough that it's a bull cycle. It needs to be strong enough and predictable and stable enough for them to say, okay, we are going to allocate dollars back to this in a major way and push these valuations up to where they were in 2007 or 2012 or 2014. So in the meantime, be patient, and nothing's changed. Nothing in my view on the macro has changed. It's just gotten stretched longer and it's gotten stretched stronger. And in the meantime, you have to be nimble. You have to adjust your portfolio allocation to meet what you feel, how the macro is going to go. So 2024, if I see higher prices, that's fantastic. But we have to realize higher prices are going to bring on more investment into the sector, especially if we go $100 plus. So to answer your question in a very, very long-winded way, I think we have a very strong floor here to oil price, especially with OPEC plus support. How high could we go? Well, that depends on both geopolitical conflict and depends on how many people are willing to come in and re-bet on the sector, especially as interest rates possibly go lower here throughout the year. But I see no reason for things to go wildly heat up, because OPEC plus is going to add barrels if things go wildly heat up. Can you make money in that time frame by picking your lows and your highs? 100%. You can make a ton of money, especially in options and XLE instruments and whatnot. But we just have a more disciplined strategy of a longer term investment. I would say 80 to 90% of the White Tundra portfolio now is set on a 12 to 24 month investment period as a minimum.
Gotcha. So longer and stronger. I could make a joke about that, but aside from that, what are some sell side indicators that you would look for on the other side? Any signposts that you kind of look out for once we do hit sort of a top?
Yeah, you bet. I really think in terms of top in oil price, you need more supply. So demand historically has continued to grow. You can make a case that with EVs and with renewables and all this, that demand is not going to grow that million barrels per day. Well, until we see signs of that, we cannot just conclude that. So Southeast Asia is still a huge growing market. We see very strong demand growth out of India, and we see some bounce back in some of the countries that were written off. So I'd mentioned this to you before the interview started, but Japanese car sales were up, vehicle sales were up 14% year over year, absolutely destroying a trend that was going down. Global vehicle sales up 12% year over year. So does that sound recessionary? There's many factors that are going against the grain in terms of what global oil demand is going to continue to do. So demand is there, supply. If there's a huge slug of supply that comes in from somewhere, let's say there's a new Permian discovered, let's say there is some sort of major offshore find that can be put into the market right away. Let's say there's major oil sands projects out of Canada being sanctioned and the timeline's accelerated. You got to be careful because really it's going to be supply that ends up killing this oil bull market. Or US shale finds a way to produce way more oil out of these fracked wells. Those are some of the posts that would give you a indication. Watch out, watch where the supply demand balance is going. And then valuation. If oil prices are at 80, 90, 100, and companies start trading at 6, 8, 10, 12 times cash flow, that's your time to think about what you want to do. It doesn't mean you're at the top. It means the skewed risk reward may no longer be in your favor. Sure, you can make an extra 30%, but your downside now is 50%. From today where we are now, what's the downside versus the upside, right? Very subjective question, but to me, it's so tilted in our favor over a longer enough time frame that it makes sense to stay in the game. But there could be times where you're sitting with all these chips on the table and you draw pocket kings. Well, maybe you still don't want to play the game because you're going to win the tournament no matter what. There's no reason to get into a huge all-in battle with the other poker players on the table. So let them fight it out. Let them kick each other out of the tournament, bust each other out, and you can sit there with your stack waiting for the next opportunity. So really, I think it's got to be a very calculated approach, and it depends on where you think valuations go. There's people that argue with me all the time saying that valuations will never reach the 2010, 2012, 2014 level. And that's your view. So if you think that's the case, well, maybe you want to exit when things are at 4 times cash flow instead of my view of this 8 times free cash flow number that I've anchored down to for the last 3 years. So I think watch the macro, watch the valuations, watch the supply demand balance, but especially watch supply. If you see supply adds that are really getting added onto the market, that's your red flag warning sign, because what killed 2023's oil or 2022 and 2023's oil price spike was not demand problems. It was the fact that we had more supply on the market than we had figured. So supply is usually the culprit, and that's really what I spend a lot of my time watching is the Brazilian FPSOs, the exports out of Iran, any sort of increase out of Chinese oil production, the US shale oil production, the Canadian production, Iraq, especially the Kurdistan region, and then any other supply adds. Norway has been a big one over the last few years. So just tracking the different source of supply, and you will have a very, very good view on where things are going. And I think patience, you really need in this market patience, and not to exit too early. And this is going to be a very polarizing statement, but a lot of people lost a lot of money because they sold their 2020 oil stocks up 40%, and they went on to go up 2,000%. So that's one of the big lessons I think that a lot of people have learned, not to sell too early. So as much as there's signposts that when you should exit, I think you should also be very careful. Yes, take your gains off the table when it makes sense to. But yeah, I'll sort of leave that as a teaser in there for you to think about, as to how many people lost out on multi-generational wealth by selling too early in 2020 or 2021 as well. So the story goes both ways. We just for some reason focus on the gains that we've lost as opposed to the gains that we've missed as well on the way up. So there's an ultra focus on the losses, or I didn't sell early enough, but people forget that there's hundreds and thousands of people who sold too early and are not in the position that some of the oil bulls from 2020 are in now, from a capital gain slash lifestyle, whatever perspective.
Yeah, it's human psychology. Actually, people tend to have a greater emotional attachment to things that they've lost versus things that they've gained. So I definitely get your point there. And on top of that, if you actually track the average holding time for a stock today versus what it was, let's say in the 1960s, in the 1960s, people were holding stocks on average for as close to as 10 years at a time. Today, it's at 5 months. So to be patient, that's something that actually gives you an edge above everyone else in this type of market. Now, you also mentioned that supply came online that was unexpected, that kind of deflated this 2022 peak that we saw. What is your take on the concept of peak oil? Have we hit peak oil? Are we getting close to hitting peak oil? Is there actually more supply than there's being accounted for? What's your take there?
Yeah, I absolutely love this question because it comes here and there, and I feel like I get a lot of interesting answers to it, or discussions to it. So I think I have one main point, and then I can sort of go tangentially off that. So if you gave me $1 trillion today, I could give you 10 million barrels per day extra out of the Canadian oil sands within 5 years. So there you go. So we have not hit peak oil. Is that a logical thing that could happen? Most likely no, because companies would have to go and put the money in the ground, knowing or betting on a higher oil price 5 years from now, taking on that risk in a higher interest rate environment, taking on debt. Oil companies traditionally love debt. They now hate debt. Would they go back to loving debt that fast? Likely not. So really, it's a matter of how high is the oil price as to whether we've hit peak oil or not. If oil price for the next 5 years is $20 a barrel, we definitely would hit a midterm or first peak on oil production. But if oil prices are where they are today, if they go higher, we can definitely produce more oil. There's more oil in the world. Brazil, I've mentioned. Iraq for sure has extra oil, especially in the Kurdistan region. Iran has extra oil fields as well. We have extra. The Canadian oil sands has immense reserve of oil that can be produced at a relatively low cost of supply, even after accounting for the upfront capital required. Venezuela, of course, is down 2 million barrels per day from where they used to be. So there is supply in the market, but what's going to bring that supply onto the market? That's really the main question. And the answer is higher prices. If you have higher prices for X number of years, it's not going to happen overnight. It might take 12 months, 24 months, 5 years of higher prices for somebody to go and say, okay, we're going to go and sanction this oil sands project. But we definitely have the supply to add onto the market, and the world needs it. The world continues to clip at that 1.5% of global liquid fuels demand per year, and we got to meet it. If we don't meet it, well, prices rise, and it's going to spur that new investment in order to meet it. So in terms of where we can add barrels from, I think I could point out 15 or 20 million barrels right now. We just need the money, the political willpower, and the actual capitalist mindset to go and think they can generate a return on this to go and do that project. So I don't think we're anywhere close to it. we've seen major efficiency gains in the US. We've seen major efficiency gains in the Western world. We've seen heavy taxation in the Western world. You look at the taxes on gasoline and diesel in France and England and Spain, and yet we're still at 103, 104 million barrels per day. I made this comment about a month ago to one of my friends. I said, you know what? If we did not have taxation on petroleum products, we could be another 5 to 10 million barrels per day of demand today. It would be an immediate increase in that over a 6 to 12 month period, because people would just flood out to go everywhere. But you're already artificially suppressing demand to such a major level, yet it continues to tick up at the rates that it does. So, I'll give you a prime example. California has one of the lowest consumption of gasoline per capita in the US. Why? Because it has the highest gasoline taxes in the US. So people are, there's X amount of EV penetration, but this fact has been true for many, many, many years, even before EVs came on the scene. So you're artificially suppressing demand already, and yet it still continues to grow. So if it continues to grow, well, we need more supply in order to meet that demand. And I think we're at that point now where there's going to come a point in time as a globe, we're going to have to pivot away from oil. We just won't have the supply at a certain point in time. We have to pivot away from oil, but in the meantime, we're going to continue consuming. And petroleum is the best drug the world has ever invented, ever. There's nothing that's even close. So given that's sort of the baseline of my view on this, I think we're going to continue rising in terms of oil demand, and therefore oil supply will need to continue to rise, and it could be higher prices. As prices rise, people are willing to pay more and more and more. The power of petroleum is so large that people are willing to pay higher prices. Yeah, they'll complain about it. Yeah, they'll make comments on Instagram about how the price of oil is too high and inflation is too high. But let's just be honest about what we're talking about. You can move a 80,000 pound semi truck for 10 miles for $4. It costs you $8 or $15 for an Uber to go 1 mile across town. So just think about how powerful petroleum is. Are you willing to walk? Are you willing to carry 80,000 pounds for 10 miles and get paid $4 for it? There's nobody in the world that's going to say yes to that. So that's just the power of petroleum, and that's what makes it the most consumed fuel on the planet, and what demand continuously going to go up, and why we need the supply to feed it. So long answer. Coming back to the point is we have the oil in the ground. It's what price is it going to take to get it out, while we as investors are betting it's going to be higher. And we're also betting that it's going to take longer this time around for people to go and start jamming money into oil projects than compared to the previous cycles, because of the PTSD, because of the higher interest rate environment, because of the lack of capital that's willing to fund these projects. And guess what? In the meantime, we fill up our under our mattresses with cash and live happily ever after.
Well, this tees me up perfectly for my next question. If you couldn't invest in oil, what would you invest in today?
Oh my God. I don't know if I would invest in anything else. It's going to be a cop-out answer, but there's one sector and one industry that I think I have an edge in, and that's the oil and gas industry. If you told me, hey, you could not invest in oil and gas, I don't think I would be in the stock markets altogether. So I would go and invest in some other.
Let's just say this. Let's just say I gave you $100,000, and the only condition was that you would have to invest it in something other than oil. What would you invest it in?
I think I would find a business. Like I would find some very high margin, high stability business, and actually buy a business instead of putting it into, well, on the stock market, you're buying a business anyway. You're buying a portion of a business, but I think I just have a better edge in finding a business around me in the real world because I don't know any other sector. I don't know any other industry as well as I do oil and gas. So I would find some sort of dealership, or I would find some apartment complex that's some sort of arbitrage there. Yeah, I would start my own business of some sort. So definitely more on the entrepreneurial side. If you gave me that money and you said you cannot you cannot invest in oil and gas, I would buy a little pressure truck and then run it up in Alberta and run it up and down, delivering chemicals and putting chemicals down the casing. So industry associate type of business. For sure, yeah. Because I definitely feel like that's where my edge is. I can find the arbitrage there and make returns that are much larger than 5, 6, 7%. Yeah, which is the historic return of the I think the S&P is about 7%. Yeah.
Yeah.
So
Well,
yeah,
I'll accept that answer. So you'd start your own business. Hey,
right.
Shubham, this was a fantastic talk. I thoroughly enjoyed it just as much as I did our first talk. If you haven't seen that episode, by the way, also check that one out. Where can people find you, Shubham? Go ahead and drop your socials.
Yeah, you bet. So most active. I did take about 3 months off, as I mentioned earlier, but I'm going to be most active on Twitter at White Tundra SG. I also do Zoom sessions completely free, about twice a month. So I'm going to reduce the frequency of them going forward. Just a different kind of methodology going forward. But so that's a whitetundra.ca. If you scroll to the bottom under events, you can see the Zoom sessions there. I do have one scheduled for this weekend, but most likely it's going to have to be moved since I'm moving apartments here on the 30th. So I don't want to get caught up in missing something there. So watch out for that. I believe February 4th. And I'm always available by email. So on the website, on the bottom, the email is there as well. And then there's a contact us form as well. So I have definitely fallen a bit behind, but has strived to answer every email and every Twitter DM as well. So yeah, I would say those are the best ways to contact at the moment. And also, if you go on the website under the archived seminars, you can see all my previous interviews, podcasts, and sessions. There's about 60 to 70 sessions, I want to say, that are on there. And of course, they're also on YouTube at White Tundra SG as well.
Great. So that's it, guys. If you enjoyed this video, be sure to give it a like. Comment down below. Let me know what you think. Do you agree or disagree with any of Shubham's points? Also, subscribe to the channel if you haven't so we can get more guests like Shubham on more often. With that said, you all, I will see you in the next episode. Bye, y'all.